Hi, Assalamualaikum, madam. My name is Akizakar bin Abdul Aziz. So I'm going to be present about basic accounting concept. For the first concept is economic entity. Okay, business economic entity is two separated things between business expenses and personal expenses. For example, I would say if the owner of the business are going to buy a car, for example, but it's for the personal use. So the personal expenses must be separated from the business expenses. Moving on to the second basic accounting concept, which is going concern. Okay, for going concern is something that we can't predict what is going to happen in the future. For example, that if I'm the CEO and I said that uh, my company will start within next month, and I can't predict with it if it will run smoothly without any problems, or it will have a problem within the meantime. Moving on to the third accounting concept which is money measurement. Okay, money measurement is a transaction of the business must be measured in a single currency, which is either in dollar or ringgit Malaysia. It doesn't matter as long as it's in a single currency.
Hi, my name is Nofarahani Minti Maradi. So today I would like to present my assignment 1 of basic accounting of Prudence Concept. Okay, what is the Prudence Concept? Under the Prudence Concept, do not overestimate the amount of revenue recognized or underestimate the amount of the expenses. Also, one should be conservative in recording of amount of asset and not underestimate the liabilities. The result should be conservatively stated financial statements. Another way of looking at prudence is to only record a revenue transaction or an asset in certain and record an expenses transaction or liability when it's probable. In addition, you would tend to delay recognize or of a revenue transaction of an asset until you are certain of it, whereas you would tend to record expenses and liabilities at once as long as they are probable. Also, regularly review assets to see if they have declined in value and liabilities to see if they have increased. In short, the tendency under the prudence concept is either not recognize profits or to at least delay the recognition until the underlying transactions are more certain. Next is the realization principles. The realization principles is the concept that revenue can only be recognized once the underlying goods or services associated with the revenue have been delivered or rendered, respectively. Thus, revenue can only be recognized after it has been earned. The best way to understand the realization principle is through the following examples. For the examples, advance payments for good. A customer pays 1,000 in advance for a custom design product. The seller does not realize that 1,000 of revenue until its work on the product is complete. Consequently, the 1,000 is initially recorded as a liability, which is then shifted to revenue only after the product is shifted. Next example is the delayed payment. A seller ships goods to a customer on credit and bills the customer 2,000 for the goods. The seller has realized the entire 2,000 as soon as the shipment has been completed, since there are no additional earning activities to complete. The delayed payment is financing issues that is unrelated to realization. Next is the accrual accounting. The general concept of accrual accounting is that economic events are recognized by matching revenues to expenses at the time when the transaction occurs, rather than when payment is made or received. This method allows the current cash inflows or outflows to be combined with future expected of cash inflows or outflows to give a more accurate picture of company current financial position. So accurate accounting is considered is the standard accounting practices for most companies except for very small businesses and individuals. The Internal Revenue Service allows qualifying small business to choose their preferred methods. The accrual methods does provide a more accurate picture of the company's current condition, but its relative complexity makes it more expensive to implement. Lastly, the periodicity in accounting. The periodicity assumption states that an organization can report its financial results within certain designated periods of time. This typically means that an entity consistently reports its results and cash flow on a monthly, quarterly, or annual basis. These time periods are kept the same over time for the sake of comparability. For example, if the reporting period for the current year is set a calendar month, then the same period should be used in the next year so that the results of the 2 years can be compared on a month-to-month basis. Once the standard periods have been set up for financial reporting, accounting procedures are designed to support the ongoing and standardized production of financial statements for the designated periods. This means that a schedule of the activities will mandate when accruals are to be posted, as well as the standard structures of the resulting journal entries.
Historical costs represent the purchase price, but it can also include all the price that make the asset as an operation asset. So for example, company A want to purchase a machine with RM 4,000 ringgit, but the company A will purchase the machine with additional RM 300 ringgit for delivery and also 200 ringgit for installing. So all the price 4,000 for machine, 300 for delivery and 200 for installing will be included in the balance sheet. So that is all called as historical cost, and also the historical cost will be the same and not going to be changed over year because although the price is going to significantly change in over time. The consistency principle states that once you decide on an accounting method or principle to use in your business, you need to stick with it and follow this method or the principle consistently throughout your accounting periods. So why do you need to stick to one? Because the sole purpose of the consistency principle or consistency concept is to ensure that transaction of events are recorded in the same way. Principle of materiality concept is the accounting principle that concern about the relevance of information and the size and nature of transactions that report in the financial statements. The main objective of this concept is to provide guidance for the accountant to prepare the entity financial statements.